All right, let's get right into it. The story of the economy right now, it's a real puzzle. On one side, things look absolutely fantastic. But on the other, well, there are some serious red flags popping up. It really is a market of contradictions. So let's start with the good news, because it's really good. The S&P 500, that huge benchmark for the US stock market, it is right there basically knocking on the door of a new record. After a pretty solid run, both the S&P and the Dow are less than 1% away from their all-time highs. Seriously, it feels like a party is about to get started. But here's the twist. While everyone's getting ready to pop the champagne, you've got major players like JP Morgan is saying there's a 40% chance of a US recession. So what in the world is going on? How can we be this close to a record high and a potential downturn at the very same time? That is the big question we're going to try and unpack today. Okay, so to get to the bottom of this, we've got to look at the market's mood right now. Because despite those huge headline-grabbing numbers, the day-to-day vibe, it's less of a roar and more of a quiet whisper. This isn't some crazy rally, it's more like a holding pattern. Just look at these tiny moves from a recent session. I mean, they show you just how flat everything is. The S&P 500, barely up. The Nasdaq, just a tick higher. And the Dow was actually down a fraction. This is like the textbook definition of a mixed, hesitant market. There's just no strong conviction one way or the other. So the big question is why? Why is the market so still? Well, it's because everybody is just waiting. Investors are digging through every last piece of economic data, just searching for any little clue about what the Federal Reserve is going to do with interest rates at their huge meeting next week. So this calm, it's really just the market holding its breath. All right, so let's get into the data itself, because this is where the story gets really, really complicated. The economy right now is sending out completely opposite signals. It's basically handing the Fed a super confusing picture to try and figure out. And you can see this confusion perfectly in the job market. It's like a tale of two different economies. On one hand, you have weekly jobless claims. That's people filing for unemployment for the first time. They came in surprisingly low, which is a sign of strength. But then, on the other hand, a totally different report shows that U.S. employers have announced almost 1.2 million job cuts this year. That's the most since 2020. So, is the job market strong or is it weak? The answer, weirdly, seems to be yes. Now, if there is one number the Fed cares about more than almost anything else, it's their favorite measure of inflation. I mean, it is the key to their entire decision-making process. And guess what? That number just dropped. And here it is. The annual core PCE inflation rate came in at 2.8%. Now, yeah, that's still above the Fed's 2% target, but the key thing here is that it has eased up. It's another piece of this puzzle that suggests the economy is cooling down, which is exactly what the Fed has been trying to make happen. And there are other clues pointing to the slowdown too. Personal income is up, which is great. Consumer spending is also up, but just by a little less. It kind of shows that, the consumer is still hanging in there, but maybe, just maybe, getting a little tired. At the same time, the 10-year Treasury yields, which is a big deal because it affects rates for everything from mortgages to car loans, is holding steady. It all paints this picture of an economy that's slowing down, for sure, but not totally collapsing. Okay, so let's zoom in a bit. Let's get away from all these abstract numbers and see what this all means for actual companies on the ground. How are real businesses dealing with this weird environment of high stock prices, but deep, deep uncertainty?
And man, you can really see this playing out in the fortunes of individual companies. I mean, look at this. You've got a clear winner in Dollar General. Its stock shot up 14% because, hey, in this economy, people are searching for value. Makes sense. Then you have Meta, up over 3% after reports they're cutting back on metaverse spending. Investors absolutely love to see that kind of cost cutting. But then, flip the coin. A giant like Kroger, their stock falls after missing revenue goals. And Oshkosh Corporation just announced 160 layoffs because of softer sales. You can literally see the economic split happening in real time, company by company.
And you know what's layered on top of all this economic fog? Another massive force: technology, specifically AI. As Larry Fink, the CEO of BlackRock, said, there are going to be some huge winners and huge failures. This disruption, it's just another powerful wild card, creating these really dramatic splits we're seeing in how companies are doing. Okay, so now let's pull way back from the day-to-day noise and take that big 30,000-foot view. Some analysts are looking at all these signals and they're asking a much, much bigger question. is an entire chapter of our economy about to come to a close. And this is a really powerful assessment from JP Morgan. They said, the US exceptionalism that we've seen in the last 2-3 years is not going to come back after this. Wow. For the last few years, the US economy has just blown past the rest of the world. That's what they mean by US exceptionalism. And their argument is that this whole period, it's ending, and it's not coming back. And this big, bold forecast is what leads us right back to that number we started with. This is the foundation for their view that there's a 40% chance of a recession in the US. It's a pretty stark warning that the underlying economic engine might be sputtering. So why are they so cautious? Well, their research points to a few key things. First, tariffs are basically acting like a tax, and they're squeezing how much money people actually have to spend. Second, business confidence all around the world, it's pretty low. And third, a slowdown in immigration is hurting the supply side of the economy, which just means fewer workers are available to fill jobs and help businesses grow. These are some big structural headwinds we're facing. So, all of this, it brings us to the main event. All these different threads, the crazy market highs, the mixed up data, the struggles we're seeing in some companies, and these gloomy long-term forecasts, they all come together and point to one single moment, the Federal Reserve's decision next week. And you know what? The market has definitely made up its mind about what it wants to happen. This chart says it all. Traders are pricing in an 87% chance of an interest rate cut. The expectation is crystal clear. The Fed needs to step in and give the economy a little help. And the Fed isn't making this call in a vacuum. Nope. It's part of what some people are calling a central bank bonanza. You've got Australia, then Canada, and then the US. All of them are making these critical rate decisions in the exact same week. This is a real moment of truth for the entire global economy. But here's the final, crucial piece of this whole puzzle. The Fed has to make this incredibly important call using the foggy, contradictory data that we've just been talking about. The next big reports on jobs and inflation, they won't even be released until after the Fed makes its announcement. They are, in a very real way, flying partially blind here. So that leaves us with the ultimate question, right? The market is betting everything on a rate cut. They're convinced it's coming and that it's going to fix things. But in this incredibly complicated world, with all these conflicting signals and underlying weaknesses, we have to ask ourselves, what happens if it's not enough? What happens if the cure the market is hoping for just doesn't work?